Now, Anthony Murphy is advising his investors to be cautious in regards to future equities. But why? Let's bring in Anthony now. Anthony, great to have your company.
Good morning, Holly, and thanks for having me on Ticker News this morning.
Anthony, why are you warning your investors to be cautious about future equities?
Yeah, I think if we look at some key statistics at the moment, particularly in the US share market is 2.1 times the size of the US economy at the moment. And to put that in perspective, pre the global financial crisis in 2009, that ratio was 1.3 times higher, and pre the dot-com boom in 99, it was 1.7 times higher. So as a result of that, valuations at the moment are really high, and we just feel investors have been forced into riskier asset classes at the moment because cash and bonds and inflation, combined with inflation, have provided them negative returns. So we're just encouraging investors at the moment to really take stock with their portfolios, and obviously many portfolios out there have done very well over the past 12 months with the rise in equity markets, and now it's time to be more considerate to that performance and preserve it as a whole.
Anthony, could you shed some light on your Alternative Investments Fund and why it's important, what it actually is, and what investors get out of it?
Yeah, sure. So the Lucerne Alternatives Investments Fund, or better known in the market as LAIF, is a fund of funds with 13 to 15 different strategies that really bear little correlation to equity markets over time. And we saw that last year in the market correction in February and March, where the market fell 30%. And we were down only 6% over that period. And by the end of May 2020, we were back above water from pre-pandemic highs. And that's really important. You know, as Buffett always says to investors, compounding is the eighth wonder of the world. So if we can preserve capital for investors when the chips are down or the circus is in town, that allows us to then grow wealth and compound off a much higher base. And you do that by allocating capital to investment specialists out there that have the ability to be really nimble and flexible, particularly when market conditions are volatile and trending downwards. And we're able to capture that through strategies such as long-short managers, but also being in pockets of the market that the broader market is yet to identify. So we did really well out of digital assets and crypto last year from early in 2020. We did really well out of the resources play by being there in April 2020 as well. And at the moment, we're biasing our portfolio and funds towards more impact investing in private debt, where a lot of capital is now being pushed into the markets.
Anthony, you guys believe that the US share market is larger than the US economy at the moment, but you guys actually believe that that's unsustainable. Can you just tell us why?
Well, just from a fundamentals perspective, US earnings at the moment from a PE ratio of 21 times, long-term average is 14 to 15 times. And you've just seen a lot of liquidity be pumped into the system over the past 12 to 18 months. And it's unsustainable. At some stage, central banks and governments around the world need to start tapering. And they don't want to. They want to continue to kick the can down the road, which is just effectively expanding the problem over time. But the reality is those safety nets that have been there from governments are going to have to be taken away at some stage. And you're starting to see that flow through already in consumer confidence numbers around the world. So in China, Europe and the US, consumer confidence numbers are on the slide, yet those economies are actually open at the moment, whilst the majority of Australia remains shut down. So we are concerned that investor sentiment is actually going to change, and that's often what drives markets lower. There can be an initial event that installs an initial market correction, but then it's actually just an overall change in investor sentiment. And so you see those earnings ratios in the US come from, say, 21 down to 15 times, and that's a correction in the market of 25 to 30%. And that could conceivably happen over the next 12 months, given the rally that we've had.
Anthony, I wanted to get your thoughts on the cryptocurrency space. Do you see that as an area of opportunity for you guys? Because traditionally it's not something that investment funds would be interested in.
Yeah, sure. I mean, look, to say you want to go and invest into crypto directly is even something that we wouldn't do. We believe identifying professionals in their respective fields of expertise is the way to go about investing. And so when we made a decision to move into digital assets and therefore cryptocurrency, again, that was made in February 2020 last year, whereas crypto really only became quite the talked about topic in investment circles in November, December last year. And so it's really about being early into a market theme. So we identified that with a manager in Richmond, Cremorne in Victoria called Apollo Capital. We felt that they were best in class in Australia to handle that allocation for our clients. With a volatile asset class like that, you need to size allocations appropriately. So our position in our overall fund was 2.5%, 3%. Through performance, that grew to a 10 to 11% weighting. And then on the back of that, you need to be disciplined and realise to take profits at the right time. And so we took those profits in March this year when Elon Musk was banging on about Dogecoin, and Dogecoin was worth 55, 60 billion US at the time. There was that euphoric state in the market. On the back of euphoria, when everybody's piling in, that's when we want to start leaving the party. But we've since continued to allocate to the space, albeit in a different strategy at the moment. So we're supportive of the theme long term, particularly because institutions around the world over the last 18, 24 months now respect that asset class, and that's also important.
I wanted to get your thoughts on our top story today. Obviously, the crisis happening over on Wall Street on the back of China's concerns with the Evergrande crisis. What's your thoughts on that?
Oh, look, I think at the moment you're seeing just a general dislocation in the market. And as I previously said, whether it's Evergrande or another tipping point in the market that's going to cause stress, you're going to see these events happen from time to time again. But I think that the greater impact, Holly, is just around investor sentiment as a whole. Wall Street at the start of last week said that they downgraded US earnings forecasts, and having an Evergrande story can just be the tipping point that initially starts that market correction. But overall, investors just need to take stock at the moment. And as I said previously in this interview, they want to preserve performance over the last 12 to 18 months. And they don't want to eradicate a lot of that. And look, if you look at a market going at the moment, BHP, it sits back to its 2019 levels because 30% has been wiped out of that stock in the last 4 weeks alone.
Anthony, great to chat with you. Thanks so much for coming on to Ticker. We'll catch up with you soon.
Thanks so much for having me, Holly. Cheers.